Okay, we'll go ahead and get started. I'm Krista Murray, and I, along with my colleagues at California Wealth Transitions, welcome you to our monthly webinar. Today, with less than 3 weeks before the election, we'll be talking about the markets and how the election and the ongoing pandemic can impact your portfolios. We'll have a presentation followed by audience questions. Feel free to submit your questions using the Q&A button at the bottom of the screen. Please don't use the chat function. We will do our best to get to all of your questions today. Our presenter today is John Leonard, who's the Executive Director for the Retail Asset Management Group of JP Morgan in Southern California. John works closely with financial advisors to provide key insights on the global markets and specifically equity, fixed income, and alternative strategies. John has over 33 years in the industry and holds the prestigious CIMA, Certified Investment Management Analyst credential. JP Morgan has over 3 trillion assets in worldwide under management. John, I'll go ahead and turn it over to you.
Thank you, Krista, and thank you everyone for having JP Morgan on the call this morning. I really appreciate your time. And so what we're going to do is use a resource that we have out. It comes out every quarter. It's called our Guide to the Markets. It's backed by 300 career analysts across the globe. And Dr. David Kelly is our chief market strategist that helps put this together. But the idea is we're all inundated with plenty of information through the various media outlets. And what we'd like to do is just see if we can present you a little more clarity to what is taking place and give you maybe some thoughts about where we go from here. The guide is, again, updated every quarter. You can see the date on this is October 14th. What we try to do is present daily updates to some of the data as well, because everything is moving so quick. So with that being said, you'll also notice within this piece that there is no opinion or product information within the guide. It's simply data, and it's how we interpret the data to give a sense of, again, where we are and where we might be headed here. With any economic presentation, there's really only 4 things you need to know, and everything else is a little bit of a filler. But you need to understand what's going on with global growth, and in particularly US growth. You need to understand what's going on within the jobs market, corporate profits, and we need to understand inflation, and that has a lot to do with the Federal Reserve and their guidance. We'll also include a couple slides around politics. Obviously, we have an election coming up. I know that's on the top of mind with everyone on this call this morning. So we're going to add a little bit of perspective there, and certainly there might be some questions around that. And then lastly, we'll finish up with what makes sense for investors going forward, which I think is probably some of the more important information at the tail end. And then I'll summarize and I'll turn the call back over to Krista and her team, and we'll go from there. So let's go to the first slide. If everyone can see that, this is what we call a services momentum chart. It's a very colorful one indeed. Lots of data on here. Let me make some sense to all of you on this chart. So it's really a PMI chart. It's a manufacturing index. And what we're looking at is the services side. So when you think of services, you have to think of financial intermediaries, transportation, communication. Green is good, red is bad. The baseline is 50. So anything above 50 is expansion. Anything under 50 is contraction. And so what we want to look at maybe is go back in time when we look at global on the top, and then it goes developed markets from there. And then on the bottom part is emerging markets. And what we're showing you back in 2008 and early parts of 2009 is pretty much everything was red. We were in a severe contraction in services, in the services sector, and also manufacturing. But that slowly transitioned into orange and yellow and eventually green. And we had a really good ride of green across the board up until this global pandemic really hit us over the head. And as you can see here in 2020, again, the services momentum really started to contract. What we're seeing today is a reversal. We are seeing a bit of a V-shaped recovery taking place, which I believe if you had the Federal Reserve on this call this morning, they would say things have gotten better quicker than they expected, both in the US and globally. And you can see some of the numbers on the far right side. Everything seems to be over 50 for the most part. In fact, the US today is at 54.6, globally at 51.6. There's still some problematic areas in Japan, Italy, and Spain, and some of the emerging markets are slowly emerging out of this situation with COVID-19. But the good news is that there is some good news on this chart, right? Things are improving. And why this is important, if you're a portfolio manager and you're investing in global equities, you want to pick up on a trend. You want to see how things are developing across the globe. Because when you have expansion in services and or manufacturing or both, what that's telling you is that the operating earnings are going higher in a lot of these various industries, but also the unemployment rates are going low. And with higher operating earnings, you get higher stock prices. So you want to be able to trade into these trends, or if you start to see things falter, you want to maybe de-risk a bit as well. So this is a pretty important chart when it comes to portfolio management, and it does let you pick up on some of those trends. The next slide just shows you a little bit incorporated on the left side with manufacturing. As you can see, what happened in the trough through this global pandemic is both the gray line, which is manufacturing, and services in purple, really took a hit. And now there's been a pretty good V-shaped recovery, as I talked about. Most of those are in expansion territory, with manufacturing a little bit higher than services, which is great. And then obviously, because of this drawdown through second quarter, we're seeing global growth down about 9.2% on a year-over-year basis. But the recovery is in effect, which is the most important takeaway. When we look specifically to the US, we are a consumer-based economy. What I mean by that is when you look at GDP, right, gross domestic product output, the US puts out roughly about $22 trillion of goods and services every year. And of that, 67.1% is consumption. We all like to spend money. We all like to spend money on ourselves, on our kids, our family. We like to travel, take advantage of all the things that we did more of pre-COVID. But that all came to a screeching halt. The peak of this economic expansion was in February of this year. March was the trough, and because of that, we lost 5% of that GDP number I mentioned in first quarter, and we lost 31.4% in the second quarter. That is a huge, huge fall off, as you can see in this chart. And so that's tough. It's going to take quite a bit of growth going forward to get that back. Now, with that being said, we do view this as what we call a bookend recession, which started with the global pandemic. It will end with a vaccine. We'll probably see a pretty sharp snapback in gross domestic product output in the third quarter of this year at about 35%. We're expected to see somewhere between 3 to 5% in the fourth quarter, and through the first half of next year, starting to moderate back to that 2% range, which is kind of where we left off before the tax cuts we had. So that, when we think about the growth story, is that we are going to get back to a more normalcy level of economic growth output, or more consistent growth output, we would say, going in the fourth quarter of next year. And that should also allow us to experience a little bit of more normalcy in our daily lives. Again, this story started with a global pandemic. It will end with a vaccine. We can touch on that a little bit more if you like. But I just wanted to put some numbers around our expectations here at JP Morgan. Specifically, when you think about the US economy as well, you have to think about areas that got hit the hardest. This is a high frequency economic activity chart, which looks at year-over-year change. And it's really some of the more sensitive areas of the economy based on that consumption story I talked about. When you think about mortgage applications, consumer debit and credit transactions, hotel occupancy, travel, navigation app usage, seated diners, TSA travel traffic, you can see in the trough in March that all of these areas got hit really, really hard. We are starting to see a pretty good snapback in some areas, particularly mortgage applications. We've seen some good data in home builders. We're certainly seeing a pretty consistent uptick in refinancing because rates are so low. Debit card transactions, credit and debit, I should say, still down, but certainly has snapped back a bit. I see the problem child in this chart is still hotel occupancy. I don't think people feel as comfortable now as they might be in the next 6 months to travel and stay in hotels. Travel navigation app usage still down. I think the real tough one has been restaurants, which you can see no one was going into restaurants at all during the trough of this. Now, at least here locally in San Diego, they're starting to allow people back inside. And of course, there's been patio seating as well. So you start to see that come back. And then TSA travel traffic is still really low. And obviously, there's a storyline around that with the airline industries needing some some bailout from the government. So very sensitive area of the economy. We're tracking this, but we are starting to see some improvements across these economic activity indicators. I often get asked a question about the markets too, and we'll tie in a little bit of that growth aspect, as we mentioned, U.S. growth getting back on track in a more consistent fashion in the end of third quarter next year. And so when we break it down by sector share of GDP, employment, and S&P, you'll notice here that the areas that got hit the hardest, that top part, was a lot of local, state, and government hiring and layoffs, agricultural, miscellaneous services, a lot of small business owners, a lot of restaurant workers, things of that nature, industrials, materials, that's 48% of nominal GDP. So again, we saw that fall off of 31.4% through the second quarter. You'll notice that technology is only about 6%, which I'll tie in just a moment. When you look at the employment picture, we lost 22.4 million jobs through this pandemic. Again, those areas that got hit the hardest represent about 44% or even more. So that's been a big number. Technology only about 2%. But again, I get the question, why does the market continue to climb this wall of worry, given the fact we don't have a vaccine, an effective vaccine yet? We have this global pandemic surrounding us, and yet we also have an election. And if you break it down on the share of the S&P, you'll notice a glaring big number there is technology. It's about 40% of the share of the S&P 500. And what we're looking at there through technology is that we are starting to see, obviously, that has become a bigger part of the S&P 500. There have been industries that have thrived through this global pandemic. I would say technology is number one. I would say healthcare is number two. Consumer staples, utilities have all done pretty well through this. And given the fact today we're doing this meeting virtually, you can see that technology has become a bigger and more important part of our daily lives. And the bottom line for a lot of companies is you'll see a lot more technology being adapted in companies to increase their profit margins. So it has been a growing part of the S&P 500, which is explaining a little bit why the markets have done so well given the circumstances we're dealing with. Now, switching topics to jobs. Again, when you look at the left-hand side, it has been very tough. We lost about over 22 million jobs. We recovered about half. So again, going back to that V-shaped story a bit, we are starting to see a nice recovery. The most important part of this chart is to understand that it is a balancing effect. When you think about local and state and federal government, the federal government trying to keep this balancing act in effect, meaning we have to find a way to keep people employed and at their jobs, but we also need to make sure it's a safe environment, particularly as we're dealing with some of the fall and winter months and a potential spike in COVID cases, what we're actually starting to see a bit now. So directionally, this is good. We don't want this to stall out. Right now, we have an unemployment rate of about 8.4%. It probably will take until 2023 before we start tapping into that under 5% level, but we need to have this directionally correct, which we do at this point. So we're hopeful that that continues as people start to get back to work. Areas that got hit the hardest, you can see here, it's been obviously leisure and hospitality. That's been a tough area. It's a big part of our employment markets. You can see that there's been the trade, transportation, there's been education, health services, all starting to get back to a little bit more of a normal level, but still a ways to go. I'd say the one that's gotten quite a while to go is the leisure and hospitality area. But it just kind of gives you an idea of how many jobs were lost, how many have been regained, and that percentage of the recovery. So let's switch a little bit into corporate profits. This is a chart that breaks down the earnings recession which we've had, and then the consensus analyst estimates. I use this chart to point out that it's a little, I guess, to say that the jobs earnings seem to be a little bit optimistic in regards to the recovery. As I mentioned, 2021 we feel is a recovery in the economy, but also in the earnings. And so when you look at this chart, the blue bars are showing the Wall Street consensus analyst estimates. And what we're showing you is a prior peak, which was 2019, that first gray bar there, which came in at a little over $160 a share on the S&P. So obviously that first blue bar is the earnings recession, which could go a little bit lower as we get final numbers at the end of this year. but it's more about that recovery in 2021. And we feel that 2021 is going to be a recovery year. It's going to be a good year for investors, but we need to maybe temper the return expectations. The reason being is that when you have a recovery in the profits of corporations, you typically don't eclipse the previous year peak, which means if 2019 came at 161, this chart's saying that the recovery is going to come in at around 162, 163. Our models, given what we know today, probably we're going to come in on the earnings per share at about 150 to 155. So I would just understand that this seems to be a little bit of a stretch for us, but we'll see how the data comes in for the remainder of this year and certainly going into next year. So why do stocks continue to climb the wall of worry? Well, this gives you a little bit of a valuation measure. And what we're showing you here is that today's stocks, they don't look cheap. I'll be very candid with you, but it's what we call the TINA effect. There is no alternative. When you look at where we're at on forward price earnings ratio. So when you buy a company, you want to think about what is the price today I'm paying for that stock, given the forward earnings of that company over the next 12 months. And you can see that the average is about 16.49. It's just a valuation gauge. And today we're at about 22.26. So why do the markets continue to go higher, even though we look at the S&P as a broad index and suggest it might be overvalued? Going back to that Tina comment, it has to do with the earnings yield spread. When you think about an investor, there's two basic choices. You either can buy their corporate bond or their corporate stock, okay? So let's take an example, generic ABC company, where I can buy their 10-year corporate bond. I can get a 2.25%, 2.5% yield off the bond. At the end of 10 years, I'll get my money back, okay? Or I can buy their corporate stock, and in most cases, I'm going to get a higher dividend yield owning that stock, but I also have the opportunity to get some capital appreciation on that stock as well over 10 years. So that earnings yield spread, that very bottom metric, is showing you the average spread of that stock given the total return of that stock versus the corporate bond. On average, it's negligible, right? You shouldn't really have much difference between the two. Today, the spread's at 1.1%. So that's still moving more money into stocks than bonds. The primary reason is because yields are so low. Investors are not getting compensated with a lot of the fixed income they'd be willing to own if yields were a bit higher. In time, that will change, but right now, stocks still look pretty attractive, even given that valuation measure of the forward price earnings multiple. So again, another comment around why the market continues to climb a wall of worry, and maybe this is another story to look at when it comes to technology. So we look at, on the left-hand side, the share of technology in the S&P 500, given the top 10 stocks in the S&P. 29.3% of the S&P 500. The top 5 stocks, technology, about 22.9. And so a lot of folks say, well, wow, that's a big part of the S&P 500 when you just look at the 10 top stocks in the S&P or the top 5. And there's a reason for that. And a lot of people want to compare it back to 1999. If those investors on the line were investing in 1999, you heard the phrase tech bubble, right? There were a lot of internet companies, a lot of startup companies, where their stock prices were going through the roof. The challenge was there wasn't a lot of earnings behind these stock prices. And it was the whole story about brick and mortar is done. We need to invest in the internet and all these tech companies coming in through it. And the idea was there wasn't a lot of earnings behind it. So when you go back to 1999 and you look at the tech bubble peak, the weight in the S&P was about 33.6. Today we're at about 28.3. So there is some difference there. The bigger difference is the earnings per share contribution. Back in the 1999 days, it was about 16.5% of the entire S&P 500. Today, technology represents 23.5% of that earnings story. So going back to that one slide I showed you with the breakdown of the sectors, you can see that technology overall and some of those growth stocks you might have been following have done pretty well through this. And again, it's just a bigger share of what's taking place in our economy as well. So that changes gears a little bit to the Fed and interest rates. So this middle box is showing you the Fed projections. It's showing you GDP, unemployment rate, inflation. We agree for the most part, a lot of these numbers we feel are fairly spot on. The unemployment rate might not get to 4.6 by 2022, we'll see. might not get down as low as 4% in 2023. And then inflation's the big one. I'll show you another slide here that shows you the inflation targeting story. Just remember that 2% long run projection on inflation. A little bit of a backdrop on the Federal Reserve. Their whole job is to control the money supply, right? They're either going to make it easier to access capital along banks and corporations, or they're going to basically retrace it back. The average Fed funds rate is 3.75, and it's the overnight borrowing cost that you'll get. If the bank goes to the Fed window and needs capital, they're going to pay a specific interest rate, or they're going to lay off a lot of the reserves on the Federal Reserve. They're going to get paid a certain interest rate. What they've done back when we started getting a little bit of inflation built in the economy, we went from zero, and you can see that step up pattern where they were raising that overnight borrowing cost about 25 basis points at a time. We got over 2%. COVID-19 happened, and then they really went very aggressive, reducing the Fed funds rate essentially to zero. And that's just a very accommodative policy. It's keeping rates very low. Yields are very low, as we know. In some sense, it's penalizing savers when you're looking at money market account yields and even CD rates. Eventually, this will change, but we don't necessarily feel it's going to change anytime soon because of this story here. So the inflation targeting story has changed dynamics. Before, as that previous slide indicated, when we got the sense of a 2% inflation rate, the Fed started to hike that Federal Reserve, that Fed funds rate higher. Now what they're doing is they're going to allow the economy to continue to have inflation in there at roughly 2%, but they're not going to raise rates until they hit about a 2.33% level. So that means that inflation has to be getting close to that 2.3% level before they consider raising the Fed funds rate. Well, I showed you that previous chart, but their long run average they think is at about 2. So the moral of the story is that rates are going to stay low for longer. We don't necessarily see rates going higher anytime soon unless we do get a surprise in inflation. You need inflation in the economy because that's important. It helps to moderate, it helps to raise prices, asset prices, and so on. A little bit of inflation is important. What the Fed doesn't really understand or know how to tackle as much is really deflation. And that's what's been happened with the COVID-19 story is it's really been more of a deflationary pressure in global markets. And so that's why the Fed was so aggressive to reduce that Fed funds rate down to zero, to get growth back on track, to get a little bit of inflation embedded in the economy, and then at some point start to raise the Fed funds rate to moderate that inflation level. Let's talk a little bit about politics. I know that's probably front and center on everyone's mind. This just gives you a snapshot of the S&P 500 index and also GDP going back to 1947. And it's giving you some numbers. It's really on the top chart showing you that if there was a Republican sweep, meaning the White House was Republican and both the Senate and the House, that over that time frame, average return in the market's about 12.9%, but it only happens 11% of the time. Democratic side, 9.8% per annum return on average, about 27% of the time. The most likely scenario in this historical chart is a divided government, which is 7.8% on the return. Still good, not quite as high, but it does happen about 2/3 of the time, which seems to be a more likely outcome. Same thing with GDP levels. When you look at Republican, Democrat, divided government, we would be thrilled to get a 2.8% economic story on a consistent basis. We think we're heading probably closer to about 2% as we get through the end of third quarter next year. But again, divided government happens majority of time, about 62% of the time within that. And then another slide on politics, and I'll add a little color commentary here as well. So consumer confidence by political affiliation. This simply means, how do you feel about current economic conditions? Do you feel we're going in the right direction? Do you feel like we're retracing? So back pre-COVID, back in February, at the peak of the economy, you could see roughly a little over 80% of Republicans felt pretty good. That obviously went down dramatically, and you're starting to see a little bit of a snapback now that we feel we've got a little bit of a better handle on the global pandemic story. The bottom blue number is Democrats, reached a peak of a little high 30s, I would say, and now that's down to about 9%. The real story here, I think, is this total number, which includes undecided and it includes independent voters and so forth. It's about 25% currently. That reached a peak, I believe, a little over 55%. And so we'll see how these numbers continue. We're getting pretty close to the election. I don't really see anything that's going to shift these numbers dramatically either way. People tend to vote with their wallet. With that being said, I think if the election was today, I think that given the poll numbers I'm seeing, I think Joe Biden would win. I think there's a chance if we get enough voter turnout that you would see a blue wave. That's kind of a scenario that could play out. We'll see how, again, the next few weeks coming into the election remain. I know that there are a lot of public speaking engagements across both candidates to see how this kind of filters out. I think given the fact if it was a sweep either side, red or blue, it's not the worst thing for the economy, because I do think that gives the opportunity for a fiscal policy to get through Congress quicker, which means that that's going to be probably a good little boost to the economy and economic growth, which is what we need. So the fiscal policy stays in effect if you do get that wave of red or blue. The other side of it is if you get a wide margin of victory, that's probably better for the markets on either side because it won't get contested. I think the challenge we're faced with the markets today is that it's a very tight race, and it does get hung up in the courts over a few weeks, kind of like going back to the Bush-Gore days. Markets went down about 10%. That's probably the worst outcome we might be looking at when it comes to investors, because that creates a level of uncertainty. And with uncertainty, investors don't like, markets don't like, and you tend to get a pretty good pickup in volatility. So really the two things we need to know through this as we get through the end of this year is we need to know that we're coming close to an effective vaccine where we can get some herd immunity taking place probably by late spring, early summer of next year. But we just need to know we have an effective vaccine. That's one. Number two is we need to know who's running the country. We need to know with Congress and with the White House who's making the decisions. And once that's embedded, then I think that we're going to be fine. But those two things is probably pretty important as we circle into 2021. With that backdrop, I think it's important to understand that we are probably looking at more volatility. And this is a chart that goes back to 1980 on the S&P. And what you'll notice here is that there are a lot of purple dots. In fact, every year there's a purple dot. That's showing you the intra-year decline from peak to trough going back to 1980 on the S&P. So every year there is some form of a sell-off. In 1987, you'll see that negative 34% number. The gray bar is showing you what the S&P finished up at for that year, which was up 2%. Again, going back to year to date, you can see down 34 again. And year to date, as of this print, S&P 500 up 8%. Just to put some numbers around that story there, in the trough of the global pandemic in late March, there was roughly about 600 plus billion that moved out of equities and went into cash and have not come back in the market and has missed about a 42% recovery. And that's a huge thing to overcome over time. So I think that a lot of money has missed out on this recovery story with the S&P being up 8%. So going back and trying to time the market is very, very difficult. Most people want to know what's the average decline to expect in any given year. It's about 14%. But yet the S&P, when you look at these gray bars, what the S&P finished up for the year, it's about 75% the S&P finishes positive, or 30 or 40 years. So again, it's just understanding that coming through this end of the year, maybe the first part of next year, that we should see a pickup in volatility, particularly if the election gets contested. And we just need to be prepared for a chart like this to understand it, that if we get a 10 to 15% pullback, it's within very normal range to get that kind of market volatility going forward. The extreme was this year at negative 34 because we had something that came completely out of left field. We didn't really know what we were dealing with, and we had that 34% decline. Things started to reopen, markets started to get better. Now we've had about a 42% recovery. So what's the best way to think about it? With any investor, I think the best offensive strategy to putting money to work in the markets is a better defense. And when you think about this periodic table, It's showing you all the main asset classes going back to 2005, so 15 years of data. And it's showing you all the best performers on the top, all the worst performers on the bottom. In 2005, you had emerging market equity, commodities, developed market equity, REITs. The white box is 60-40, so it's 60% equity, 40% bonds. It's a mixture of all these various asset classes. Green is S&P, orange is small cap, blue high yield, you have cash, and then you have on the bottom fixed income. So one thing you'll see on that 60-40, that white box, it's never the top performer, but it's never the worst. It's always right in the middle. And when you look at year to date, it's up about 2.6% compared to other areas. Yes, you could be up close to 9.6 as of the print of this chart, but nobody puts all their money 100% in stocks, because you know why? The key with this chart is it allows you to stay fully invested when you do have these types of major volatility events like we had in March or first quarter of this year. So standard deviation, a measure of volatility, has always been consistent with that 60-40 at 10%. So again, having your assets properly diversified is probably the best ingredient for successful investors, because it allows you to stay fully invested when you start to go through these episodic events like we've had this year with the global pandemic and COVID-19. So I'm going to leave it there. Kristen, turn the call back over to you to see, I guess, if we're going to do any questions at this point.
Yeah, John, thank you very much for your comments. We have just a couple of questions. There's been a lot of discussion about potential tax changes if the Democrats win the election. Can you talk about the timing of when those kinds of tax changes may occur?
Yeah, that's a great question. I think that's top of mind on a lot of folks. And so, look, taxes are going to go up. At some point, they have to. We have a growing deficit. You either are going to get a pickup in growth in the economy, which we can with fiscal policy, which I mentioned earlier. So you need to grow the economy growing at plus 3%, or you're going to do a combination of that plus taxes are going higher. So we don't deny that. It's not a matter of if, it's when. The when question can be answered when we get through the recovery, right? So 2021 is a recovery both in global markets, but also U.S. economy, and it's a recovery on earnings. And you don't raise taxes through a recovery year. We have to get the unemployment rate down further. We got to get people back to work. You don't hit them with a higher tax bill. So we feel that taxes probably will go, if you want to like pick on corporate tax rates, for example, proposed through the Biden administration at 28%, probably start being platformed in 2022, and either might be retroactive, but probably initiated in 2023 once we know there's a firm economic expansion in place and the unemployment rate starts to get a bit lower. That being said, what's 28% look like? Well, it's higher than today, no question about it, but it's still a lot lower than where we came from. The effective tax rate of that's probably closer to 25% when you get through a lot of the write-downs that businesses can do. And when you think about it compared to global markets, it's still going to be a competitive rate because there is debt that's been amassed across all developed markets. And we do think that taxes are going to go higher across most countries. So I do feel that 28% is still a good story. It just means that you're probably going to have to temper the bottom line or the earnings of company stocks to come down a bit, just because you have to provide for that bit of a higher tax rate going forward. So I think their tax story is definitely with us. Taxes are going up. It's just a matter of when. We think it's probably more likely towards the end of 2022, going into 2023.
Okay, thank you, John. Would you say the same thing for individual tax rates? Same timeline for them as well?
Yeah, I think so. Because again, we're dealing with a too high of an unemployment rate, still 8.5%. We're still dealing with a lot of struggling business owners across the country. And we're looking at a lot of companies that aren't going to make it through this, or a lot of small business owners that won't. And we're still wrangling over more stimulus. And how do we provide that to mom and pops and big industries like airlines, for example? So there is a lot of that that's still taking place, and it needs to filter into the economy first. And probably again, 2022, 2023 is probably more likely than next year.
Okay, that's good news. Can you comment for a minute on some of those downtrodden industries? You mentioned how well technology has been doing,
Yeah.
and so on. Is it too soon to start investing in restaurants, airlines, and commercial real estate? Or is that now a good time to look?
You know, it depends on your timeline, right? Investing always with JP Morgan is a long-term story. So I think a lot of these industries are going to get aid, especially the airlines. We can't afford to be without our major carriers. It's kind of a bottom feeding story. I think it incorporates a lot more volatility for some of those company stocks. So it might be a little early still on that level. But when you start to see profits getting a bit higher, then I think that's a good way to maybe miss the complete bottom of the stock price, but maybe start to chip in when you start to see a clear recovery. Airlines need, like hotels, they need a pretty significant occupancy rate, right? They need higher than 80%. And right now you saw the numbers when I showed you that high frequency data, they're still down, TSA travel traffic down, 90 something percent. So it's really tough right now, very tough. And with this every other seat, when you do take a flight, is not profitable for airlines. So I think there's some time left still if you want to bottom feed in some of those industries. I think airlines are tough. Cruise line industry is tough. Some of the restaurant chains are tough. Some of the industrials and materials could be maybe a better bet if we get into a cycle of more clear path of growth, which we do think will be next year. So it's really a story of active management is the most important, because you want to decipher which industries and companies are going to make it through this and benefit at a later point versus some companies that what we call zombie companies that aren't going to make it. And that's an important differentiation between the two. Okay.
Just two more questions and then we're going to wrap up. Mentioned earlier the change in corporate tax rates. Any industries that you think would be impacted disproportionately, either positively or negatively from a change in corporate tax rates?
I think the corporate tax rate across the board will be fair to a lot of companies. I don't think there's any major differences between the two. It's not the corporate tax rate, it's more of the regulatory environment and how different industries get treated. We've heard dialogue probably through the debates of, breaking up technology, breaking up financials, breaking up companies. If that was embedded, you'd have to see how that affects the bottom line of these companies and their ancillary businesses. Regulation can be a little bit of a stymie for corporate profits as well. We saw that in 2008 through a lot of the bigger money center banks. So we have to understand the corporate profit story is probably going to be fair across the board. It just means you need to temper the earnings on a lot of these companies a little bit lower. Some you may not want to own simply because they have that on top of the challenge through, just what's going on in their industry in general. But I do think that the regulatory environment could be a little bit more of an impediment than corporate taxes.
Okay, thank you. Our last question has to do if maybe you could share again that slide you showed the returns of when the Republicans were in office versus the Democrats.
Yeah, let me get to that real quick here.
Okay.
You're referring to, I think, this slide here?
Yeah, exactly. And
okay.
Actually, the question was, can you share it again, which you're doing, so there's no big answer. I'm going to use it to talk about our poll. So it very nicely with this slide. For those of you that participated, thank you. On this call, we have 48% Republicans, 35% Democrats, and the balance were independent and undecided. The Democratic president is in office. Stock market returns are 30% thought above average, 43% thought about the same, and 26% below average. The Republican president is in office. Stock market returns 57% thought above average, 39% about the same, and only 4% below average. I think the good news is we would all be very happy with either 12.9% a year or 9.8% a year. One of those we'd be pretty happy with for the next 4 years. The question says, if Biden gets elected, the stock market will perform strongly, 17%, average 39%, poorly 43%. And if he gets reelected, the stock market will perform strongly, 39%, average 3% and only 17% poorly. So our audience thinks that the Republicans are better for the stock market than the Democrats. The history shows that really the market would do well no matter who's in office, which is why the stock market seems to do well year after year. I would share one last thought before we wrap up. Fidelity recently did a study of their best performing accounts over the past 10 years. And what do you think they found? The accounts where the people seem to have forgotten that they had invested their money performed better than all the other accounts. The message I take from that is try not to watch the news, try not to pay too attention to the media. As John said, have your money invested in an appropriate allocation and then leave it alone. On behalf of all of us at California Wealth Transitions, thank you for listening today. We're going to continue to do these once a month. And our next one is actually going to be on restricted stock units for those that are corporate executives. And we'll alternate between sort of topics like that and then market updates as this. John, thank you very much for your comments. And thank you for participating. Also, a recording of this webinar will be available on our website.